Hi, good evening, everybody. We welcome everyone to what is the 20th in a series of webinars that's hosted by Vaish Associates. Today, we will be speaking on the topic of directors' do's and don'ts. We'll request all participants to put their mics on mute and please ask your questions in the question answer box in your system, which is on the right hand side, and we will deal with the questions at the end of the session. And I'll just give you a brief introduction of the speakers today. So the first speaker is our colleague and a managing partner of Vaish Associates. He's Mr. Bhomi Daruwala. He specializes in mergers and acquisitions, restructuring of business, asset and share purchase deals, takeovers, disinvestments, security offerings, structuring of complex debt and equity investments, and general corporate and tax advisory. He also advises business houses on corporate governance issues. Mr. Ravi Rajgopal, our external speaker, is currently the chairman of Fortis Healthcare, a listed entity in India. He is also an independent director for Airtel Africa and Vedanta Resources Limited. He is also acted as an independent director for several companies, and we look forward to hear from him his experience as an independent director. Mr. Amit Tandon is the founder and managing director of Institutional Investor Advisory Services India Limited. This is a SEBI registered research firm which is dedicated to providing the participants in the Indian market with independent opinion, research, data on corporate governance issues. We look hearing his experience as a representative of a premier proxy advisory firm. Then the other two speakers are my colleagues. Mr. Krishna Kishore, who is an associate partner at Vaish Associates. He specializes in advising corporate clients on acquisitions, dispositions of business, and general corporate and commercial counseling and advisory. He has significant experience in advising clients on white-collar crimes and investigations, disputes and offenses relating to the Companies Act and foreign exchange regulations. Lastly, Mr. Amarjeevan Joshi is also an associate partner at Vaish Associates. He specializes in counseling clients on corporate structurings, mergers and acquisitions, business asset and stock purchase deals, SEBI takeovers, joint ventures and foreign collaborations, as well as private equity arbitration and IBC matters. And I am Srinivas Shankran. I am a principal associate with Vaish Associates, and I will be the moderator for this session. Now, today we will be speaking about the do's and don'ts as a director, and what are the important things to be borne in mind for a director when he takes on the role in the company. Board of directors of a company are role models in ethical practices, and their work culture, attitudes, behavior percolates across the company and goes straight to the bottom line. It motivates the employees, increases their confidence level and output. Due to globalization, increased role of media, speed of communications, watched by various regulatory agencies, there is now greater demand for accountability and transparency from directors. Generally, a director plays a dual role as an agent of a company as well as a person with a fiduciary duty to the company while discharging his duties. The board has a power and authority to carry on activities of the company and to meet the business objectives of the company as a team. A director has to exercise his duty independently, regardless of who has nominated him. Now, what is a fiduciary duty? If you look at the definition offered by Black's Law Dictionary, it is a duty to act for someone else's benefit while subordinating one's personal benefit to that other person. So the basic principle under the company law in this regard is also the same. Now, in this situation that we all faced in today of COVID-19 and its uncertain impact on businesses, directors have got an even larger role to play in steering the company out of financial troubles and ensuring smooth performance. So I will now pass on the mic to my colleagues, Mr. Krishna Kishore and Amit Jeevan, who will speak on certain do's and don'ts for directors, as well as the regulatory landscape on which a director is required to operate and the responsibilities. Over to you, Amit Jeevan and Krishna.
Thank you, Srinivas. Good evening and namaste to everybody. So to start with the session, firstly, I would like to touch upon the categories of directors. So basis the categories, we have categorized director basis their function and liability into three categories. First category is an executive director director and a director who is an employee of a company, these are primarily two kinds of executive director. Can be a managing director or a whole-time director. The second category is a non-executive, non-independent directors. These are generally the promoter-appointed directors or promoter themselves acting as a director, or nominee directors appointed by the financial institutions. The third category is an independent director who does not fit into either of the above two categories and who fulfills the certain criteria of independence like experience, expertise, integrity as provided under section 149. Now, when an individual is intended to be appointed as a director on a board of any Indian company, what that individual should do? The individual should try to find out the role category of the director he is going to take up, as it's very important when it comes to the functions and liabilities. If you are supposed to be appointed as a non-executive role and you already have certain other commitments, then you need to decide whether you will be able to effectively contribute to the company or not. You should also check on the number of existing directorship, as there are certain caps provided for an individual at the same point of time. He can be a director in a private limited company, public, or a listed company as an independent director. If you are being appointed as an independent director, then you need to confirm that you meet the test of the independence as prescribed under the Companies Act and the SEBI LODR. You are also required to register yourself as an independent director in the data bank maintained by the Indian Institute of Corporate Affairs, where you are required to give your educational, professional details. And additionally, these details are required to be submitted by 30th of September 2020 as per the recent amendment. Secondly, you are also required to undergo a mandatory proficiency test when you are proposed, once your name is registered in the data bank. This test is supposed to be undertaken within a period of 12 months, but this test is not mandatory in cases for certain individuals who have been a director or a key managerial personnel for a period of 10 years or more in case of a listed entity or an unlisted public company having a paid up capital of 10 crores or more, or a body corporate listed on a recognized stock exchange. Apart from that, you need to confirm that you are not disqualified to act as a director. You should also try to know about the existing board members, their roles and functions. You should try to review the code of conduct and other policies which are uploaded on the website of the companies, as these does not only apply to the employees of the company, but equally also apply to the board of directors. You should try to know your duties, roles, function, the responsibility, rights, and your liabilities associated with the position of a director. You should try to understand the distinction between a role of a board, which is supervisory in nature, and the management, which is supposed to look into the operational matters. And in case you have already been a CEO and or an executive director, and now you are proposed to be appointed as an independent director, then your focus should be on analyzing, understanding, and providing special expertise which you have, rather than getting into the operational matters. Apart from that, one should also try to read the documents available about the company in the public domain relating to something like memorandum and articles, their annual reports, their financial statements, to understand the health of the company or the corporate governance aspect. A director should also acquaint himself about the business of the company, its products or services, competitors, and general industry environment associated with that business line. Apart from that, a director is also required to obtain a DIN DSC if they don't already have. They will be required to provide certain disclosures about their interest in any other companies under Form MBP1 and disclosure regarding their non-disqualification. They are also required to issue a consent form once they are appointed. Now, once you are appointed, what you should do? In case if you are appointed on a board of a listed entity, then you should disclose your holding of securities and also inform your portfolio manager that you have been appointed as a director, and instruct him not to deal in the securities of the company specifically during the period of closure of trading window. In case you are also appointed as a member of any committees of the board, then you should try to understand the role of such committees, what kind of functions are being discharged by that committees. Apart from that, you should also ensure that you are covered under the directors and officers insurance policy of the company, or you have an indemnity agreement in place. This aspect will be dealt in greater detail by Mr. Daruwala later. One should also undertake the induction program organized by the company. Once you are appointed, you should also schedule some meetings and with the management and senior officials, including internal auditor, to understand about the functioning of the company. You can also schedule visits to the company's plants and locations to see how they are operating. You can also consider inspecting the minutes of the board meetings and the statutory registers and the shareholders meeting to see how the corporate governance or the record keeping is. You should also inquire about the existing related party transactions between the company and the promoters and necessary corporate authorizations. Apart from that, you should also look into this loans and advances which have been given to promoters or its group companies. What is the current amount of outstanding, whether there have been any default in the past relating to repayment of these loans and advances. One should also inquire about the credit facilities which have been availed by the company and its subsidiaries. What kind of securities has been provided? Are there any corporate guarantees provided? And other details relating to that. Now, coming to the Companies Act, the sections 166 is the provision which deals with the duties of the directors, and these duties equally apply to all kinds of directors, irrespective of whether you are an executive director or a non-executive or you are an independent director. It contemplates that a director has to act as per the articles of association of the company. What does it mean? It does not imply that the company has to necessarily incorporate all the duties of the director in their articles of association. If it is done, it is the desirable thing, and the company should endeavor try to list down the duties of the director in the articles of association. A director is supposed to act in good faith to promote the objects of the company for the benefits of its members, in the best interest of companies, employees, shareholders, community, and for protection of environment. Now, in the current scenario, if you see, the companies are actually under financial stress owing to COVID-19. And if the company has to chooses to fire its employees and do a pay cut, how the directors will have to deal, because they have to also at the same point of time have to protect the interest of the employees of the companies also. So this is something, a scenario which the directors will have to deal with and decide with their application of mind as what is the best thing suited for the benefit of the company as well as for the employees. A director is also supposed to exercise their duties with reasonable care, skill, and diligence, and to exercise independent judgment. They are not supposed to involve in a situation in which they may have a direct or indirect interest and that conflicts. For example, in case a director gets a business opportunity, meeting with somebody, and he should not try to do that business maybe individually. He should try to pass on that business opportunity to the company maybe. A director is not also not to achieve any attempt or to achieve any undue gain or advantage either to himself or for his relatives. He is not supposed to assign his office in case any assignment is done that is considered as void under the law. Now, we will discuss briefly about two case laws relating to Section 166 as how the courts have considered. The Delhi High Court in the matter of Rajiv Soumitra versus Neetu Singh and others had observed that the Section 166 is akin to the common law right, and it is merely a repository to the director's fiduciary duty. Essentially, it talks about that the duties whatsoever is provided under the 166 is the kind of a fiduciary duty, which is a kind of a nature of a trust. Now, coming to the second case, which was where the Gujarat High Court in the matter of Ajay Surendra Patel versus Deputy Commissioner of Income Tax had observed that where a director is leaving the matter to the discretion of other directors without supervision and also for making loans without inquiry for what purpose those loans were made, and consequently when the company suffered a loss in a transaction, the directors were held responsible for the same. Also, the fiduciary position of a director in a company does not permit the director to throw always up their hands and say that we knew nothing as we did not take part in the proceedings. Under the common law right, the fiduciary duties of the directors as listed on the slide, you can see this is quite similar to what is provided under the Section 166. Apart from that, from the common law principles, while determining whether a director complied with his or her fiduciary duty, the court applies the approach of objective test. Essentially, it means whether in circumstances a reasonable person could have believed that the particular act was in the best interest of the company or not. Now, apart from the duties listed in 166, there are certain responsibilities and certain duties which a director should do under the various other provisions of the Companies Act. A director should strive to attend all the meetings of the board and the committee wherever he is a member. In any case, a director should at least attend one board meeting within a period of 12 months. Otherwise, his office will become vacant. Now, the board meetings can be attended either by physical mode or by way of an audio-visual mode. Recently, the government has come out with a circular where there are certain matters which was required to be considered only at the board meeting can now be considered by way of audio-visual meetings also up to 30th of September 2020. Now, a director should also ensure that the prospectus which is issued does not contain any misstatements. Uh, they should also ensure that the full particulars of the loans given, investments made, or guarantee given, or security provided is disclosed to the members in the financial statement. They have to also ensure that the loan to any entity in which director is interested, there is a due compliance of law which also contemplates about the special resolution, and the loan should be utilized by the borrower for its principal business activities. Apart from that, there is various other responsibilities on the director relating to the accounts and accounting policies and bookkeeping. It contemplates that the accounting policies should be applied consistently to give a true and fair view of the state of affairs of the company. They have to also ensure that the company complies with the obligation relating to CSR if it is applicable to them. Every independent director is also required at the first meeting of the board in every financial year to give a declaration that he meets the criteria of independence. Once, sorry, the director has to also ensure that adequate and functional visual mechanism, if it is applicable, is there, and there is a protection provided to the whistleblower. They should also disclose their interest or concern at the first meeting of the board in which they participate every financial year. The office of a director shall become vacant in case he fails to disclose his interest in any contract or arrangement in which he is directly or indirectly interested. Where any director is interested in any contract or arrangement and that such matter is considered at a board meeting, then he should be not participating for that specific agenda item during the course of the meeting. A director is also supposed to provide his comments on the draft minutes within a period of 7 days once it is circulated. In case there are discrepancy between the decisions which were taken and what is recorded, we should bring it out to the notice of the board promptly. When any amount is intended to be contributed to any political party, they have to ensure that the proper authorization from the board is there and the amounts contributed is disclosed in the profit and loss account. To avoid disqualification, director should cause all the companies where there are director to file their financial statements and annual returns. Apart from that, the director should periodically review the financial and secretarial records of the company to keep himself updated about the compliance status. And if there are any concerns, he should raise that to the board. The director is also required to submit a e-form DIR 3 KYC annually on or before 30th of September. Other do's from a good corporate governance perspective, which a director should do, they should regularly update and refresh their skill, knowledge, and try to familiarize with the new operations, if any, undertaken by the company. They should try to attend the general meetings of the company to understand what kind of grievances the shareholders or other stakeholders have, or try to clarify their doubts at the meeting. They should ensure that adequate deliberations are held before approval of any related party transactions and ensure that the same are the interest of the company. In case of any material related party transaction, one has to ensure that approval from the shareholders are in place and those contracts are actually disclosed in the board report with the justification. The loan and investment transaction must be carefully evaluated by the board. The board should also examine the budget to ensure that the projected expenses and income are comprehensive and realistic. In case you are participating in any board meeting, you have to give your consent on dissent on a particular agenda item. You should ensure it is duly recorded in the minutes. In case you are not present during any specific agenda item, then one must ensure that the same is duly recorded in the minutes. Prior to the meeting, once you receive the information, you should try to go through them. In case if you feel it's not adequate, you should ask for more information from the management or ask prior to the meeting or at the meeting for applying your mind to come to a judgment. In case of resignation, specifically in case of independent directors who are on the listed company, they are required to provide detailed reasons for resignation and a confirmation that there are no material reasons other than those provided. One should also try to retain the acknowledgement of the resignation letter, as the law contemplates the resignation is effective from the date mentioned in the resignation letter, or the date when the company received the resignation letter, whichever is later. A non-executive director should refrain from signing checks or regular communication on behalf of the company. A director should also have some kind of a vigilance in case of an unlisted companies. The financials of the unlisted company and the investments made by them should be carefully checked by the audit committee of the listed company. Uh, Apart from that, the minutes of the unlisted subsidiary should also be tabled before the board of the listed companies, and the board should also have a frequent meetings with the management of the unlisted subsidiary company. Now, considering the COVID times, there are certain practical steps that the board can take to mitigate claims at the future date. They should keep themselves updated on the guidelines which are issued from time to time by the central and state governments, and ensure that the same are duly followed by the company. They have to ensure that the current policies, whatsoever they have relating to employees work, relating to work from home, cyber policies, ITs, as people are working remotely, are updated. They should provide a safe and hygienic workplace as we are opening up, so they should have to ensure the SOPs are followed as per the guidelines provided by the government. They have to also create maybe a disaster management plan, and which should be duly documented in the minutes of the meeting. There should be adequate group insurance policies, and information about the same should be notified to all the employees. The board and the management should also assess the risk involved in performance of its obligation under the four material commercial contracts. Any material adverse effect on the operation should be duly notified to the stock exchanges. In addition to the foregoing, we would also like recommend directors to check on the certain items, early warning signs or red flags about the potential wrongdoings, which may turn out to be fraudulent at a later date. This could include whenever there is an increase in borrowing, despite there are huge cash and cash equivalents in the company's books. There is a default in payment of undisputed payment to the statutory bodies. The funds are coming from other banks to liquidate the outstanding loan. There is a disproportionate change in other current assets. There are large number of transactions with interconnected companies and large outstanding from such companies. There are raids conducted by tax officials or other governmental authorities. There could be significant reduction in the stake of the promoter or increase in the pledged shares. There is a resignation of a statutory auditor abruptly, or there is a resignation of a key manager and frequent changes in the senior management. So all these instances should raise a red flag, and you should look into the company. Apart from these, there are specific rules for independent directors prescribed under the Companies Act, under Schedule 4 of the Act, which provides for the code for independent directors. Without waste, many of these things I have already covered in my previous slide, so I will briefly only touch upon few of them, the salient one. An independent director is supposed to uphold ethical standards of integrity. They are supposed to devote sufficient time and attention to his professional obligations. They have to assist the company in implementing the best corporate governance practices. Under the roles and functions, they have to bring in an independent judgment on issues relating to strategy, performance, risk management, resources, key appointments, and standards of conduct. They have to satisfy themselves on the integrity of the financial information, and the financial controls and the systems of risk management are robust and defensible. They have to moderate and arbitrate in situations of conflict between the management and the shareholders' interests. Under the duties, they have to seek appropriate clarification or amplification of information, take and follow appropriate professional advice and opinion of outside experts if required. They should participate constructively and actively in the board meetings and the committee meetings. Where they have any concerns about the running of the company or a proposed action, they have to ensure that these are addressed by the board, and to the extent they are not resolved, insist that the concerns are recorded in the minutes. There is another provision under the Schedule 4 which contemplates that on at least one board meeting in a financial year should be done only within the presence of the independent director, and there should non-independent directors and management should not participate in such meeting. The focus area of the meeting should be to review the performance of non-independent directors and the board as a whole, to review the performance of the chairperson, to assess the quality, quantity, and timelines of flow of information between the management and the board. Apart from this, there is another provision which contemplates that the board as a whole has to evaluate the performance of the independent directors, and a statement to the said effect is required to be mentioned in the director's report. On the basis of the report of the performance evaluation, it shall be determined whether to extend or continue the term of the independent directors or not. So now I'll hand over to Amit Jeevan Joshi, who will be taking us through the responsibilities of directors under the SEBI regulations, responsibilities under the IBC, responsibilities under the direct and indirect laws, and certain don'ts for independent directors. Over to Amit Jeevan.
Thank you very much, Krishna, and good evening and namaskar to friends and participants. I would be taking through, as Krishna mentioned, some of the dues and responsibilities for directors, duties for directors under the SEBI regulations. I will also touch upon the important provisions that directors should keep in mind from IBC law perspective, which has an impact on the role of directors during the insolvency period and the twilight period, what is provided in the IBC. Finally, I'll touch upon provisions under Direct Tax Act and Income Tax Act and CGST Act also, which directors should keep in mind. So in terms of SEBI regulations, the responsibilities has been cast upon by SEBI based on the category of directors, and as my friend Krishna has already covered, even SEBI classifies directors in the form of executive, non-executive, and independent directors. And although the term independent directors is only defined in Regulation 16, the term executive and non-executive directors are not defined in SEBI LODR regulations. Based on the category of directors a particular person is, responsibilities are cast upon directors to perform their obligations under the Act as well as under the rules and regulations prepared by SEBI. In terms of disclosure requirements, there are disclosure requirements under SEBI LODR, PIT, and ICDR regulations, which are applicable to all the directors, irrespective of their category which they fall into. Like, for example, pecuniary relationship with a company needs to be disclosed in the annual report by all the directors. And also, there are certain responsibilities which have been cast upon each and every director of the board, whether it be an executive director or a non-executive director. For example, disclosure of any indirect or direct material interest in transactions and which affects the company. They are expected to maintain operational transparency towards shareholders. Directors are also expected to comply with certain other responsibilities like providing strategic guidance and set a corporate culture and encourage a positive thinking towards in the organization, as this will sort of percolate towards down below in the organization as well. So these responsibilities are coded in the SEBI LODR, and the directors are expected to perform these functions during their tenure as a director in the company. Directors are also responsible for framing, implementing, and monitoring the risk management plan and code of conduct, which is required to be framed as well, which they would need to follow or their in compliance with the function as a director of a listed entity. In terms of Regulation 7 of SEBI LODR, it specifies certain minimum set of information which needs to be placed before the board of directors in order to comply the functions which have been cast upon them. For example, annual operating plans and budget, quarterly results, minutes of the meetings, information in relation to recruitment and remuneration of senior officers, including CFO, any demand notices or prosecution or penalty notices, serious accidents, certain kind of material defaults or financial obligations, product liability or public liability claims, important transactions like joint venture and collaboration agreements, substantial payments towards acquisitions of intellectual property or goodwill in the businesses, any significant sale of investments or material subsidiaries or material assets which are not in normal ordinary course of business of the listed entity. So these are some important information which needs to be placed before the board of directors for them to perform their functions and to oversee the operations of the listed company. And directors are expected to ensure that this information is supplied to them by the management. In terms of certain disclosures under the inside trading regulations, as you would be aware, The directors are expected to disclose their holdings in securities within 7 days of their appointment to the board, and also on the ongoing continuous basis, they are expected to deal and disclose their trading in the security market within 2 trading days of such transaction happening, specifically for the threshold of 10 lakhs or above. They need to disclose it to the company on an ongoing basis. So these are some important disclosures that, from a SEBI perspective. I'm not, for the sake of time, I'm not going to deep into the functions which have been reported, which is mostly in common with companies that. But let's just delve upon some important provisions from insolvency and bankruptcy code, which the directors are supposed to keep in mind. Now, usually what happens is the duties of directors are primarily towards the shareholders in the company. But during the twilight period in the IBC, that suddenly the directors have a duty to protect creditors' interest over the shareholders' interest, and directors who fail to protect the interest of creditors are may be held liable under Section 66 and other provisions of the IBC. So directors are expected to perform these functions as independently and in the interest of creditors as is prescribed in the IBC. Now, what are these important provisions? We'll look into each of them. There are certain avoidable transactions which NCLT is empowered to undo to protect the interest of creditors and other stakeholders. So the conduct of directors who authorize this transaction may be called into question in certain circumstances, and in such cases, director may be may incur personal liability if the NCLT so determines. The unavoidable transactions which have been listed down in the IBC are preferential transaction under Section 43 of IBC. Now, what is a preferential transaction is prescribed in a very famous and landmark judgment of JP Infratech Limited versus Axis Bank Limited, which was decided by the Supreme Court. An honorable Supreme Court in this landmark case set the precedent for what is exactly the preferential transaction. What happened in this case is that certain security interests created by JP Infratech Limited in favor of lenders of the holding company Jayaprakash Associates Limited, and in case of a challenge, Supreme Court ruled that the following transactions, following cases, or if following conditions are met, the transaction would amount to a preferential transaction. So the Supreme Court basically specified 3 tests for setting for deeming a particular transaction as a preferential transaction. The transaction which is in the nature of transfer of property or interest of the corporate debtor for the benefit of a particular creditor on account of an antecedent financial debt or operational debt or other liability, that kind of a transaction which has the effect of putting such creditor towards whose benefit as the transaction has been carried out in a beneficial position than it would have been in the event of distribution of assets in accordance with Section 53 of the code. And such transaction, if has been carried out during the 2-year period prior to CRP in case of a related party transaction, and 1 year in other cases, may fall into the category of a preferential transaction. In fact, Supreme Court said that transfer if that does satisfy these 3 test conditions, then they would be deemed and presumed to be a preferential transaction. And of course, there are certain exceptions like transfers which have been carried out in the ordinary course of business and all that. So if those tests and conditions are met, these would be deemed to be preferential transactions. And Supreme Court also distinguished Section 43 of the code vis-a-vis the Section 328 of the Companies Act, which also talks about fraudulent preference, specifying that 43 does not really contemplate a requirement of intent or a fraud to fall within the parameters of this provision. So, second category of transaction which is avoidable is undervalued transaction. Here also, I would like to cite a case law of IDBI Limited versus JP Infratech Limited, wherein what happened is a petition was filed to declare the transaction entered into by promoters and directors of corporate debtor creating mortgage of property as illegal. Now, what happened here is the account of the corporate debtor was declared as an NPA, and directors of the corporate debtor, in utter disregard to their fiduciary duties and duty of care towards the creditors of the corporate debtor, mortgage about 800 acres of unencumbered land owned by the corporate debtor to secure the debt of related party, which was a parent company here. The value of land was in the range of about 6,000 crores approximately. and there was no counter guarantee which was obtained from a related party in favor of which the debt was created, the security interest was created. And while deciding on this transaction, NCLT bench of the Allahabad bench of NCLT decided that this transaction is fraudulent and preferential and undervalued, as it was carried on during the period of 2 years preceding the commencement of inventory. So look back period of 2 years for a related party transaction and 1 year in case of other transactions applies in this case as well. In terms of other transactions which are avoidable are deliberate transactions to defraud creditors by keeping assets of the corporate debtor beyond the reach of the person who is entitled to make claim, which is provided under section 49 of IBC. Here, no lookout period has been provided. But the key distinction between undervalued transaction and transaction defrauding creditors is that section 49 deals with the undervalued transaction undertaken with a malified or wrongful intention, but whereas section 45 no such element is required. So another distinction is, of course, that no lookout period, lookback period isn't provided for under section 49, where a lookback period has been provided for section 45. Lastly, I think extraordinary credit transactions are also certain avoidable transactions, which will be basically these are transactions which involve receipt of financial or operational debt. Now, what distinguishes this kind of transactions with other avoidable transactions is that the other avoidable transaction seeks to address transfer of assets by the corporate debtor. However, extraordinary transactions addresses receipt of credit by the corporate debtor, although the ultimate effect is the transfer of value outside the corporate debtor. Now, certain examples of extraordinary trade transaction is basically certain credit agreements being entered into which grossly contravenes fair principles of lending, and certain examples may be signing agreements without actually reading the contents, or signing a contract under intimidation, or concealing important conditions out of the important conditions under small letters or things like that. Now, here we can quote a case law of Sinan Bank versus Sunil Indian Private Limited, in Sunil India Private Limited, where the New Delhi bench of NCLT held that agreed rate of interest in this particular case was 65% per annum, which definitely amounts to an extortionate transaction. And in fact, the NCLT Delhi also observed that generally in transactions, even interest rate of 24% per annum has been also considered as an acceptable by the parties, but it is a quite exorbitant interest rate, which in this case was agreed between the parties. Now, what happens also is that the directors are there might be an unlimited liability which may cast on directors to contribute to the assets of the corporate debtor if NCLT determines that a director has been part of a transaction which can be considered as a fraudulent trading transaction under section 66 subsection 1 of IBC. What this transaction basically is, where a director can be held liable if he is knowingly party to carrying on a business of the corporate debtor with intent to defraud creditors of the corporate debtor or any fraudulent transaction. Now, here also I would like to also highlight that no look back period has been provided for, similar to section 49 of the IBC. Now, originally all these provisions were not there in the Companies Act, and they have been sort of imported from UK legislation. Now, fraudulent trading conditions are like sections applicable not only to internal persons like directors, but also outside persons. And the important element is that it has to be dishonest intention on the part of a particular person to defraud the creditor. So as long as there is no dishonest intention to defraud the creditor, the directors are not expected to be personally liable towards such transactions. Now, what important points which emerges out of these provisions? The important points and important do's which emerges out of these provisions is basically directors need to be vigilant and make attempts to mitigate the losses to the creditors and protect their interests. They should take steps to preserve the value of the assets of the corporate debtor and avoid taking any step which increases their liability. Debtors are expected to perform similar due diligence which could be performed by a reasonable and competent rational person in his place, and they are expected to act in fiduciary capacity in the interest of the company. Now, in terms of standard duties which are provided in the CIP, I'll just briefly touch upon them. As you know that once the CIP is announced, the powers of the board of directors are suspended. But having said that, directors are personal as defined under the IBC, so they are expected to extend their assistance and cooperation to the resolution professional in managing the affairs of the corporate debtor. Also, directors are entitled to receive notices for the meetings of committee of creditors, and they are expected to attend the meetings of COC. Of course, they won't have right to voting, but they can give their views on to COC in respect of resolution plans being approved by COC. Now, here I would like to also highlight the case of Vijay Kumar Jain versus Standard Chartered Bank, where Supreme Court held that for effective participation in the COC meetings, directors should be given copies of resolution plan and agenda papers, important papers to decide on the resolution plan, which have been placed before the COC. Similar duties have been cast upon directors in the liquidation process. I won't go into detail of that. But what important dues which emerges out of this discussion is that directors are basically expected to monitor the financial position of the company from time to time, ensure compliance specifically in terms of any financial or other covenants in loan agreements. Directors are expected to exercise due diligence and take reasonable steps to protect the interest of creditors, and transactions, specifically the transaction that involves transfer of assets or value out of the company, shall be very carefully verified before they are approved by the directors in during the tenure. There is sufficient. They should ensure that there is sufficient documentation on record evidencing that the transaction of the such transactions of the company were undertaken for fair value and based on reasonable diligence and inquiry into the affairs of the company, and these transactions were relevant and necessary in the interest of the company. Now, creation of new undertakings or new liabilities by the company should be fully scrutinized before they are approved. And if need be, directors can always seek external advice while evaluating such transactions. I would like to touch upon very briefly, the important provisions under the Income Tax Act, which the directors should take note of. Section 179 of the Income Tax Act imposes joint and several liabilities on every director of a private company for recovery of tax dues, should the same not be recoverable from the hands of the company. So, in such an event, the provisions of IT Act, which relates to recovery and all, will also apply to directors as they were applied to an SSC company. If the director is able to demonstrate that non-recovery cannot be attributed to any gross neglect, breach, or misperformance on duty on his part in relation to affairs, then there will not be any liability cast on the director. Similar provisions have also been there in Section 88, subsection 3 of the CGST Act. I think key takeaways which we can note from this provision is basically on non-payment of dues by the company. Directors are held liable jointly and severally, and if there is there will not be a liability on the director if he proves that the non-recovery of dues is not due to any gross neglect or breach of duty on his part in relation to affairs of the company. Since the time is short, I'll just quickly go through the important don'ts for directors. Krishna, so I think the important don'ts which I would like to highlight for you is that directors are expected to be fully participating in the board discussions, and they should disclose the interest, direct material or direct or indirect interest which on the transaction which comes up before the board for discussion, and not to withhold information that may be relevant for such board decisions. They are not to involve themselves in routine or day-to-day business for the management unless they are executive directors who we are talking about. Confidential information and details of the meetings should not be shared, obviously. Directors should resist taking any gifts, any personal fee and all that kind of transactions from counterparties and other people like that. It's important that proper discussions on each item of agenda which has been placed with the board is being discussed properly, and the decision is properly recorded in the minutes of the meeting before this item can be approved by the board. Directors should not create a hostile environment within the board as it may lead to certain other consequences. Now, without wasting much time, as these are most of the fourth ones, and this is already on your screen, I would like to now pass this on it to Srinivas. Back to you, Srinivas.
Thank you, Amit Jeevan. We will now invite Mr. Ravi Rajgopal to share his experience and views as an independent director.
Uh, Srinivas, can you hear me?
Yes, we can hear you.
Very well. Good evening, everybody, and thank you to Bhumi and Vaish for inviting me to join you in this session. I currently sit on the boards of some companies both in the UK as well as India, and therefore I have a pretty good view of how boards are run in both countries. And I thought I'd share some of my experiences with you in the way I see the role of directors in terms of do's and don'ts. In both countries, of course, there are shareholders and regulators, and the expectations are broadly similar, although there are some differences as to what they expect with their boards. My experience is that each country's system has its advantages and drawbacks, but there are aspects which each country could learn from one another. The recent spate of corporate blow-ups have caused people in both countries to question the role played by boards in oversight and governance. In India, companies such as Island FS, Cox and Kings, and Deccan Housing have in recent time been driven to the cliff's edge, as you all know. Equally, in just the last 6 months, two major companies in Europe have collapsed in a way that people in India might see as eerily familiar. One story unfolding right now this week is a German company called Wirecard, which is the biggest fintech company in Germany, and they handle online payments on behalf of various clients. And they finally acknowledged this Monday that 1.9 billion euro was missing from their bank accounts. Now, while the story finally unraveled this week, the Financial Times had, over the last 4 years, it had been writing about Wirecard's questionable accounting practices. But the reaction these exposés led to was both the company and the German regulators started alleging that these stories were a fabrication by short sellers. The second instance was NMC Health, which is a leading healthcare company in the Middle East, but listed on the London Stock Exchange, and in fact, a member of the FTSE 100 companies. 4 months ago or so, NMC publicly admitted that the founder had pledged far more of his shareholding than he had previously declared. Also, monies lent to group companies were unlikely to be recovered. Now, does that sound familiar to you? The point I'm making is twofold. However good the surrounding ecosystem is, in terms of regulators, auditors, management, and so on, the board has to be conscious of its duty to seek assurances and ask the right questions, to triangulate information by cross-checking information from different sources. Trust the management, no doubt, but verify. The director's duty would, in my view, consist of two parts. First, at a foundational level, ensure the basics work. In terms of controls, reliability of financial processes, quality of compliance, both with internal procedures as also with external regulators. If these have passed the confidence test, the second more important duty is to exercise due process and due diligence to promote shareholder and stakeholder interests. This often means ensuring the strategy will deliver the expectations, that the CEO and team have the required competencies, that cash is prudently managed to meet growth needs, that sufficient spending in innovation happens so that competition does not steal a march. Not paying attention to the first, in terms of the basics, can land you in trouble. Ignoring the second bucket, in terms of the value add, begs the question as to what exactly are the directors doing. For after all, they were placed in the company by the shareholders to represent and promote their interest. This fact is often forgotten. Being on the boards both in UK and India, it is interesting to see some contrast in the approach to expectations of companies and their boards. This is a purely personal viewpoint, and others may think differently. In India, the way I've seen it is the company laws are highly prescriptive. To an extent, one can say the trust factor in expecting companies to do the right thing is not a given. Some of this may have to do with the history of most companies in India having been founded and then led by promoters, which is often not the case in the UK, where the shareholding is far more widely held. To illustrate, far too many items in India require board approval, and one wonders whether that results in any added assurance to anyone. Reliance on senior management alone is not seen as sufficient enough. For example, I've seen authorized signatories for banks and power of attorney holders requiring board approval. In each board meeting, these often run into 10 to 15 pages. The board meeting attendance register, the receipt of sitting fees, and the minutes, which are written on special legal paper, all require personal signatures of every board member. These are not the norm here in the UK. In India, a large number of committees are legally mandated. Committees such as CSR, stakeholder, investor grievance, independent directors, and so on. In the UK, it is just the audit committee and the nomination and remuneration committee. The rest depends on the company's own priorities. In India, board processes are very largely guided by legislation. Here in the UK, we have the Financial Reporting Council, which recommends good practices for running audit committees and boards. These are not legally mandated. They even cover matters like women representatives on the board. For example, the guidance that came out 7-8 years ago, suggesting that at least 1/3 of the board membership should be women candidates, which has largely been fulfilled now after 7-8 years in all the FTSE 100 companies. These guidance on good practice detail matters such as ESG, and also recent recommendations have covered areas like protecting the reputation of the company and talking about resilience and viability and not just going concern. Not adopting these recommended practices do not result in a legal violation, but auditors, proxy advisors, and investors do pay close attention to whether a company is complying with these FRC recommendations, and their feedback is deemed critical to how the stock is rated. Hence, they carry a lot of weight. However, given the string of recent collapses, there is a growing debate in the UK that the UK laws need to be a lot more prescriptive. Like in India, Sarbanes-Oxley is also cited as the way to go, given its rigorous review of controls. Equally, I think India can do a lot more to encourage the spirit of what a director should do and be less prescriptive, and encourage a set of good or best practices, and put the owners on the markets to judge a company on where they stand on the spectrum. Hopefully, at some stage, we could see a midway path for both countries. My own view of how I need to play my role as a director stemmed from my early days in management. I would often be in the boardroom with proposals that required the board's considered view. I would finish a 30-minute presentation, and at the end, there would just be a few cursory questions from the directors asked of me. And I often wondered why the board was not showing more involvement, asking questions that made you think, elevating the debate to a much larger context so one could think of a broader impact, and share with you the benefit of their own experiences in their respective spheres. Empathy for the management's expectation of how the board needed to play its role formed my own views on how I should play mine. I therefore look at building a trusting relationship with both the CEO and the senior management as the basis for defining the board's role. This involves agreeing with the CEO a way of working where both are complementing each other's roles in framing and delivering the strategy. That does not mean supporting the CEO blindly, but asking questions and setting the expectations that deepen the trust and build a relationship of support. As I earlier said, trust but verify. This also involves getting to really understand the business by traveling around, seeing the operations firsthand, meeting the people and getting a sense of their clarity and commitment, reading about what is happening to competition and to the industry. I could go on, but the short point is often putting myself in the shoes of the management and the shareholders and saying to myself, if they are relying on me to safeguard their interests and build the company prosperity, how should I do my job? When I was working with, I'm just going on to a couple of experiences in the recent past that try and illustrate the points I've made so far. So I was working with Diageo for a very long time, the drinks company, and towards the latter part, in one of my roles, we acquired a major shareholding in United Spirits in India, the spirits company again. Having negotiated the transaction with a flamboyant promoter, it was important for Diageo to build trust with all stakeholders and that we would put their interests foremost soon after we acquired our controlling shareholding in the company. For the first few years, I led these efforts. We nominated independent directors, people whose public standing was beyond question. Secondly, we nominees on the board on behalf of Diageo made it clear to the independent directors that bringing good governance and transparency was paramount, and we would support all actions they undertook to achieve this. Many of you may know Arun Gandhi of Tata Sons, and he was our first audit committee chairman after we came in to United Spirits. And his efforts played a major role in bringing that good governance, bringing rigorous accounting and transparency into the financials. My second experience has been more recent, one where Vaish and Bhumi have been more closely involved, was at Fortis Healthcare. I remember meeting Mr. Injeti Srinivas, the Company Law Ministry Secretary, who described the induction of the three of us into the Fortis board, and he explained it as corporate democracy in action in terms of international shareholders nominating us with an expectation of bringing good governance and transparency. Mr. Srinivas said this was the first time this had happened in India, and I don't know, subsequent to our coming into Fortis, there have been other instances. Bhumi could probably talk to that, or even Mr. Amit Tandon, who has extensively documented, I think, the work we did at Fortis, and I'm not going to go into the details. But our role was defined along three lines. First, when we came into the company, it was on the brink of bankruptcy. So therefore, whatever we did, we had to make sure we could keep the lights burning. Management and the board had the same objective: restore reputation and morale and induct a strategic investor. This brought an urgency and a shared purpose to the role. It made things a lot easier in terms of going about getting the things we needed to do. Secondly, decisions were the outcome of processes and not individual actions. Recommendations made by lawyers, bankers, auditors, forensic experts were the outcome of an agreed process, and all decisions were seen as an outcome of a combined effort, transparently placed before the board or with regulators wherever required. Thirdly, and finally, within a year, and once we had a full-time managing director and a majority investor on the board, we ensured governance and reputation remained at the forefront of everything we did. Here we were lucky to have the full support of the investor whose philosophy was fully aligned with ours. Thank you. With that, I'll pause and hand it back to Srinivas, and we can take questions at the appropriate time. Over to you, Srinivas.
Thank you very much. Thank you very much. We will now request Mr. Amit Tandon to share his perspective and views as a representative of a premier proxy advisory firm especially in the context of various situations where proxy firms have found an issue with the conduct of directors. Over to you, Mr. Tandon. Mr. Tandon?
Okay, I've now been unmuted. I hope you people can see.
Yes, yes, we are able to hear you.
Okay, great. Thanks a lot, Srinivas. This has been wonderful listening to your colleagues and to Ravi Rajgopal. One of the things I've maintained for a while is that if we had more investors and more boards behaving like the way Fortis did, corporate India would be in a far, far better place than it is today. So it's been a pleasure listening to him and all the others. Rather than first jump deep into or do a deep dive into what is happening with regard to proxy advisory firms and the pushback which we've given, etc., I'll kind of spend some time just talking about what has changed in the environment, so that suddenly there's so much focus with regard to what do proxy advisory firms do. The first is the fact that there's been a lot of regulatory action with regard to boards and with regard to independent directors. So we had the new Companies Act, and I won't get into the specifics because those have been touched by in this two sessions before I've spoken. But I'd suffice it to say that there were a couple of fairly interesting developments which took place there, and the two I'd like to highlight are the fact that you began e-voting. And once e-voting became mandatory, a consequence of that was that each vote started getting counted, or each share started getting counted as one vote. So before that, if you went for a meeting, it was pretty much through show of hands. After e-voting, what's happened is that you don't have to kind of physically be present for an AGM. You don't have to have shairi, mushaira. You don't have to go through all that. What you're doing is you're kind of listening to what is happening now. You can do it with webcam, but in any case, you were able to vote on the shareholder meetings, and that has had a fairly important change with regard to how what we see happening in companies and why firms like ourselves have started playing a more important role. The second, of course, is, in terms of regulations, we've kind of seen that, you had the Companies Act, you had the listing guidelines, which kind of gave way to the LODR. You've had a revamp or some refresh of the Companies Act 2013 itself. SEBI set up the Kotak committee, and one of the things which the Kotak committee focused was they kind of highlighted the fact that there are two gatekeepers for companies, and these are independent directors and these are auditors, and they kind of tasked them with greater roles and greater responsibilities over this period. So long and short of it is, what I'm saying is, over the last 6, 7, 8 years, what we've seen is a greater thrust on governance, a better understanding or a better articulation of what the roles and responsibility of directors are. And it also recognizes the fact that directors are playing a very important role as far as the management of companies is concerned. And that's again something which Ravi referred to when he spoke about his experience in companies both here and in the UK. The second aspect, which is, when I kind of look at the environment and say what has kind of changed a little bit, is the fact that equity ownership has changed quite a bit in the last decade or so. So when we came out of the financial crisis in 2008-9, the promoters held about 60% of the equity. The institutional shareholders collectively, that's the mutual funds, the insurance companies, the various other pension funds, were pretty much at a nascent stage at that stage. FIIs. They held about 20-21% of the shares for, and I'm talking very broadly. There might be individual differences in certain companies, but very broadly across the market. When we look at the shareholding today, what we find is that the institutional investors now hold about 35-36% of the equity, and the promoter holding, which was at 60%, has now come down to 55%. So this has fairly important consequences. One is the fact that for every 3 shares that the promoter held about a decade ago, for 1 share that the institutional investors held, the promoter now holds about 1.4 shares for every 1 share that the institutional investors hold. So collectively, institutional investors have become much more powerful, and collectively they have a greater voice in the management of companies, and that of course has consequences. One of which is the fact that, when collectively they hold 36%, it's not unusual to find that there are instances where individual funds hold about 7 or 8 or 9% in the equity in a company. So sometime back, you will remember when we had L&T making a bid for Mindtree. You had Nalanda Capital, which was sitting on 10% holding, and the outcome of that battle was to be determined to a large extent by how Nalanda is going to vote. You see that it's not unusual to find that HDFC Asset Management holds 6 or 7% in a large number of mid caps in which they've invested. So one consequence of this is that investors have started kind of sitting across the table from the companies and company boards, and not something, someone who kind of comes in at the time of the AGM, maybe comes in for one investor meeting. And one consequence that they're sitting across the table is, and there's the collective voices, that they're getting heard. And we need to remember that, people might have different views on strategy. They might have different views in terms of how businesses need to be run. But if you look at aspects of governance, what the board structures are, what the processes are, that kind of cuts across geographies. So whether you're staying in the UK or you're in India or you're an investor in the US, you will find that there's very broad consensus in terms of what are good practices. And we kind of heard echoes in that when we heard stories about Wirecard, what happens, and whether it resonates with what is happening in India. So I think this is giving you some context. The fact that, we now have an environment which is kind of putting greater responsibilities on boards, and combining it with the fact that there is a great deal of focus on governance, combined with the fact that you've now got e-voting and you've got greater institutional shareholding, means that the environment in which the board of directors today need to operate is significantly different from what it was 6, 7, 8 years ago. What it's meant is there's more complexity, but more importantly, there is greater accountability of the directors, and the expectations from what they're doing, how they're behaving, what the investors expect from them is also much, much higher. I just want to kind of just take one step back and have one other observation which I want to leave on the table, which is that, it's often asked about, given the fact that someone might be on the board of a Birla company, or you might be on one of the other promoter companies, do independent directors have a role to play, or is it just that the primary responsibility is that of the controlling shareholder, and the promoters are just there as a kind of for some kind of checks and balances? And there I find that the response of the global investors is very different from that of the domestic investors. So the global investors are used to independent directors playing a far more involved role and far more engaged role in global companies, and they expect some of those practices to permeate into the Indian market. The domestic investors, for some extent, still turn around and are of the view that, look, at the end of the day, we are going to turn to the controlling shareholder to kind of sort out this mess. But having said so, there is, of course, some move from the domestic investors to kind of ask the question in terms of what are the independent directors doing. And again, no better example of that than what we saw in Fortis when global investors asked for some change, saying that we are not happy with the role of the independent directors. We want independent directors to come in who are able to kind of take a more broader view, work in the interest of the company rather than tick the box to everything the promoter is saying. And we've kind of seen it having a fairly decisive impact in terms of what has happened. Of course, we'd like to see more of it, but that's a conversation for some other time. Now, as far as the proxy advisors themselves and role which firms like us play, I'd like to kind of first say that pretty much most of our recommendations tend to be contextual. So there is, of course, one or two recommendations where we do want, we kind of say there's a little bit of arithmetic in it, and the most important of these, which might affect a lot of you, is the tenure on the board. Now, as we know, the Companies Act has said that, look, people have to be on the board for 10 years, but they've kind of said effective from the date of the new Companies Act. So it kicks in from 2014. Our view is that, in other words, if someone's been on the board from 2009, they'll start counting it from 2014. As a voting advisory firm, we look at the date from when you got first appointed to the board. So if you've been on the board from 2009, we'll kind of count your tenure from 2009. As a consequence, one of the resolutions we vote against the most is appointment of independent directors on the board. And therefore, I think you see a lot of against votes coming from us. If you kind of were to exclude this, you'll find that our recommendations tend to be fairly contextual. I just want to point to one instance where, not one instance, but surprisingly, the resolutions which investors vote against the most are not things like related party transactions, but the focus is most on ESOP resolutions. And this comes from a philosophical difference between how investors view ESOPs and how promoters and managements view ESOPs. Managements view ESOPs as deferred compensation. And therefore, what they say is, look, I need to pay someone, let's say 1 crore, but what I'm going to do is I'm going to pay them 60 lakhs and I'm going to give them shares at a discount or ESOPs, which will be at not linked to market price, but maybe at face value or at a 30, 40, 50% discount to the market price. And hopefully they'll get some of the upside from this. Investors see it as pay at risk. So they say, look, if I've entered the share at 100 rupees today, can the management and the management team drive the share price from 100 to 150? Only if they do that do they make returns. If the share price comes down to even 80 rupees, the employees will make some money, but as an investor, I will not make any money. So that's surprisingly, which is not something we would have expected. You would have thought that, investors would say that they're happy to get employees get a reward.
Mr. Tandon,
yes, please.
I'm sorry to interrupt. We have lost your webcam feed. Could you just enable that? Thank you very much.
So that's one of the things. I want to just talk about another few, what we are observing from the market and from the investors. One of the other observations I have is that one of the matters which is now fairly important for investors is if there's a sale of a business, they want clear articulation of how the proceeds from that sale of the business will be distributed. It's not something which was earlier happening, which you say that you're going to sell off a business and sit tight on the proceeds. Investors want a disclosure. What we find is that there is a greater discussion along these aspects. And I want to throw up one other statistics which I should have done so a little bit earlier when we kind of look at the various resolutions which have been defeated over the past, you don't kind of find that it's kind of bucketed into saying that only resolutions for ESOPs are going to be defeated, or resolutions for something like related party transactions are going to be defeated. What we find is it's kind of spread across different businesses. So it could be compensation, it could be related party transactions, it could be appointment of independent directors. And therefore, it's very difficult to generalize and say that there is one factor which is kind of driving investors, but which brings me to the point with which I started, which is the fact that our recommendations tend to be contextual, and this is how investors also tend to vote. They kind of try and understand the context. And sometimes if you look at something like Sun TV, one of the resolutions has been both Dayanidhi Maran and his wife, both have been kind of getting 80 crores as compensation. So investors kind of vote differently on the two resolutions. For one of them, they have 90% support. For the other, there is 60% of the investors vote. So therefore, they're kind of making a distinction even on the same resolution, where you would expect that, look, if it's the same resolution, they're going to be broadly supportive of it. But they kind of look at what these nuances are. I kind of mentioned going forward, what are the changes we expect other than the fact that use of proceeds. One of the changes I expect we are going to start to see is that investors are going to start focusing much more on governance of group companies. If you look at what's happened at ILFS, if you look at some of the other instances, a lot of it happens because of the leakages which happen from these subsidiaries and other group companies. You've seen that happen in a lot of the infrastructure projects. You've seen that happen in a lot of the real estate companies. And those will be increasing an area of focus. And therefore, there will be increased pressure in terms of what is going to be happening on group companies. I could kind of go on and give you a few more examples, but I believe I've kind of run out of allocated time. But I just want to leave one final thought with you, which is, we are often asked in terms of what is the role of a director? Is it, is it compliance? Is it strategy? Is it some of them have even said that we are informal advisors to the promoter group, and therefore they kind of talk to us about, the various children and who could be the right successor, and so on and so forth. While all that is true, what we believe is that the role of the promoters is to save the promoters from themselves. You find that the promoters often kind of take fairly large bets with the companies. They kind of take on a lot of debt. They might kind of pledge their shares and borrow a lot of money. And we've kind of seen that all of these things have consequences for the businesses they run. So if I were to say, if I'm asked, and what we say is that the role of the board is to save the promoters from themselves. If the people on the board recognize that, I think there'll be far more clarity in terms of what the expectations from the investors are from the various directors. I'm going to stop short here and hand the microphone back to Sridhar. Thank you very much.
Thank you, Mr. Tandon. Thank you very much for your views. Next, I'd like to request Mr. Daruwala to come on and on the mic and share his views on particularly the liabilities of directors. Mr. Daruwala, you're on mute.
Sorry, am I audible now?
Yes, you are.
Okay, good. So when I was doing my chartered accountancy and law about 35 years back, at that particular point of time, the position of director was a very cushy position and virtually without any liabilities. And the directors used to simply do the line of the promoters. So at that particular point of time, we had only Companies Act 1956, and what we understood was fiduciary duties towards the company. That's the only thing which we could understand. Then came Companies Act 2013, and as was mentioned by my colleagues, that Section 166 came, and it expanded the duty to various stakeholders, which included the shareholders, employees, community, protection of environment, etc. Then, we had this IBC, which again was touched upon. Now, this is a dangerous provision where there is a duty to the creditors. The heading of the provision says fraudulent trading or wrongful trading, and my colleagues emphasized on subsection 1. But the more dangerous one is the subsection 2, which has no linkage to fraudulent trading or wrongful trading. And the way the subsection 2 reads is that on an application of a resolution professional, the adjudicating authority, which is NCLT, may by order direct that the director shall make good out of his funds into the assets of the company for what? If before the insolvency commencement date, such director knew or ought to have known that there was a reasonable prospect of avoiding commencement of corporate insolvency resolution process in respect of such corporate debtor, and such director did not exercise due diligence to minimize the potential loss to the creditors. Now, frankly, this is very dangerous, and the meaning of due diligence has been given in the explanation, and the meaning is due diligence means whatever diligence a reasonable person in those circumstances is expected to do. Now, technically, if you see, if while the company is in a stress situation and a debt is incurred, and suppose, imagine a situation that the debt could not be paid and the company lands into CIRP, then technically, as per this provision, the directors can be hauled up, and then the directors will have to prove that they acted diligently. So I personally feel, you are actually encouraging the directors by virtue of this provision to resign before the company gets into financial hardship, which is not a healthy scenario. And I think if at all the section needs to be there, it should be linked to some fraudulent trading or wrongful trading, but it should not be so open-ended. Now, typically in case of liabilities of directors, it's a very subjective matter. And what I have noticed is that when the chips are down, the heat on the directors is the most. And there is no uniform practice. So for example, in Satyam's case, there was a hole in the balance sheet. And what we found was that the independent directors lost their reputation, but they didn't face any grave adverse consequences. Now take the case of Nagarjuna Finance. There they were not able to pay the depositors, and there's a special act in Andhra Pradesh to protect the interests of the depositors. Now before this default happened, Mr. Nimesh Kampani had resigned, but still he was hauled up by the authorities, and the guy had to be in Dubai for 9 months just to avoid arrest by the Andhra police. And he came back to India only when the Andhra Pradesh High Court stayed the proceedings against him. In Airtel's case, again the chips were down and the company went into corporate insolvency resolution process. And the NCLT directed that the promoters, directors, CMD, they can't travel abroad without permission. Now, one of the directors came to NCLT again saying that please give me permission to travel abroad. So the NCLT says that this is not within our jurisdiction to give the permission, approach the relevant authority. Same thing happened in this Chitra Sharma's case, which is this JP project, where the home buyers were affected. Again, the Supreme Court passed an order saying that, look, the directors should not alienate their personal assets and should not leave the country. Now, Section 149(12) of the Companies Act is meant to protect the independent director, and they say that they shall not be liable for the acts or omission of the company, provided it has not occurred with his knowledge or with his consent or connivance, or he has not acted diligently. Now, the difficulty is not acted diligently. The expression is so subjective that somebody can be hauled up by saying that you should have acted in a particular manner. Now, if you see this expression, there's a famous case of P.A. Tendulkar decided by the Supreme Court, which gives an indication that the longer your duration as a director, the more you should have known about the company. And, it says that a director may be shown to be placed and to have been so closely and so long associated personally with the management of the company that he will be deemed to be not merely cognizant of, but liable for fraud in the conduct of the business of the company, even though no specific act of dishonesty is proved against him. He cannot shut his eyes to what must be obvious to everyone who examines the affairs of the company, even superficially. So, failure to attend board meetings, not raising the right questions, not keeping a track of developments will all point to the direction that the director has not acted diligently. MCA has also provided relief by telling ROC that, unless you have specific instances of directors not acting diligently, you don't prosecute them. But the problem with Section 149(12) of the Companies Act and the MCA General Circular is that it gives protection to the independent director for offences under the Companies Act. It does not give any protection for offences under other statutes. Now, there is a concept of vicarious liability. Vicarious liability means that for offences of the company, the persons in charge of the management of the company will be held liable. Now, that person, if he wants to escape punishment, he will have to prove that contravention happened without his knowledge and he exercised all the due diligence. Now, invariably, what happens is that you have cases where this vicarious liability provision is there and the authorities just lock, stock and barrel put all directors. The difficulty in such cases is that the court does not discharge the independent directors in the first instance. They say let the proceedings continue and let the directors during the court of the proceedings prove that they were not involved in the affairs of the company and this decision happened without the knowledge. Now, participating in this affairs is the big problem. And I would also just give an example of one of a case of a company, and it's quite fashionable these days to convert civil cases into criminal cases. So there was an instance where an offense was committed in a company, a so-called criminal offense was committed in a company. The police took cognizance. Of course, the police was managed in that particular case. But a CEO joins the company after the offense takes place. So he's a new CEO. He was not there during the period of the offense, but they managed to get the police issue summons to the CEO. Now, when the CEO went for quashing of summons in the High Court, the High Court just refused to quash it. The High Court was told that the CEO had joined later after the offense, but they refused to quash it. The matter went to Supreme Court, and Supreme Court had to quash the summons. So you can see how much pain and how much time effort is required just to get the liability quashed. So that is the problem. Problem is not the legislation. The problem is the procedure which is followed in the courts. Now, how do you protect yourselves? I think each director should take and ensure that there is indemnification provision in the articles. The model article which is there in table F of the Companies Act in Article 91 provides for indemnification, but it says that the indemnification will be only given if the judgment is in favor or the director is acquitted. Now, directors' officers' liability policy was not fashionable earlier, but now it is considered to be a necessity in view of the number of cases which are there. But it also has certain exclusions. It can't protect you from a criminal liability. It can't protect you from any prior or pending litigation. It may not protect you from dishonest or fraudulent acts. Environmental cases may not be protected. Insider trading cases may not be protected. And also you have to remember that any contribution made by the company to the directors and officers insurance policy that is not treated as part of the remuneration of the managerial personnel. But if that person is proved to be guilty, then the premium paid on the insurance will be treated as part of the remuneration. Now, I would say that there are few things which one can do to mitigate the liability. So you have a concept of officer in default, and if possible, nominate a person as an officer in default for various provisions of the Companies Act, so that if there is any issue with respect to compliance of the provisions, then the liability falls on the officer in default. Same way, there are provisions in the Factories Act and Legal Metrology Act and various other statutes where you can nominate people for compliance of responsibilities under the Act. I think the directors should take advantage of these provisions. And even otherwise, as a good corporate practice, I think the departmental heads should be responsible for compliance of the various provisions of the various statutes which they encounter with, and the directors should take certification from the various departmental heads regarding the compliance on a periodical basis. A good thing is that the ministry or the government is trying to decriminalize minor economic offenses, and as a result of which at least the fear of punishment will go away and there will be an ease of doing business. So thank you for the time, and over to you, Srinivas.
Thank you very much, sir. We will now take a few questions that we have received both before the webinar and even during the webinars. So the first question, I think this will be directed to Mr. Rajgopal. Let me just enable his. Mr. Rajgopal, are you?
Yes, I can hear you.
So the question is, we see increasing instances of independent directors being prosecuted for misstatements in financial accounts. Is it possible for an independent director to examine every book of account and voucher, and can they rely on the senior management? What does an independent director need to look at while approving financial statements of companies?
I think it's the answer lies in partly what Mr. Tandon said previously, as also Bomi, in terms of due diligence and due process. Due diligence in terms of not individual effort, but as a board, collectively, whether they are making sure that there are processes and controls that would protect and provide the reliability of the financials that are reported and will be published. So it's not just looking at the financial statements, but it goes into all the sort of work that is carried out in producing those financial statements that are then put up to the board. Clearly, this can't happen in the course of a meeting. This would have required the foundational work that would have gone back in time, say the previous 6 months or a year, as I said, collectively. And if the independent director is a newer member, that person has to seek that assurance from the other members and the board. So it's really about making sure that the required processes exist, they are vibrant and robust, and they're also supplemented by conversations that the board would have, for example, with the CFO, with the auditors in private, and with the internal auditor privately. These all provide the further reinforcements about the confidence level the board would have. But I think the most important thing is to look at the control systems, the processes, the reporting, the compensating controls in terms of checks and balances. That entire environment has to be looked at, which would then point to the assurance the financial statements would have when they are placed with the board.
Thank you very much, sir. The next question, this appears to be directed to Mr. Amit Tandon.
Hello.
Thank you very much, Mr. Gopal. Are you able to hear me?
Yes, I can.
Thank you, sir. The next question is to Mr. Tandon, and the question is, why haven't we seen in India cases being initiated as class action suits, especially when we have statutory recognition and enforceability under the Companies Act 2013? Mr. Tandon?
Yeah, I can hear you. I think the way I see it is that the concept of class action suits in India is relatively new, and the threshold was defined only about a year ago. So, in a sense, it's a little bit too early to comment on it whether, as a mechanism, it will be successful in India or not. We also need to kind of keep in mind the holding structure of Indian listed companies, where you've got a promoter or a controlling shareholder who has a significant chunk of the holding, and the remainder is kind of widely dispersed. So rarely is it possible to kind of get individual shareholders to meet the threshold on which it is possible to file your cases, which is there, unless there's a major private equity investor, and the private equity investors kind of prefer to address these things through shareholder agreements rather than go through the a class action suit. Uh, I'm kind of taking into account just the fact that it's 1 year old. And finally, we need to remember that, look, at the end of the day, there's very little case law. You don't know how much time it's going to take. What people are wanting to do through such things is that, look, if they have some assurance of immediate relief or relief in a fairly short duration, it makes sense for them to do so. But to have a disparate group of investors who kind of get together after 1 or 2 or 3 years, they kind of tend to lose steam. So we've seen what happened in when you had the cases against the in the commodity exchange, etc., where there was a great deal of enthusiasm in the initial stages, but after some time, it was very difficult to kind of get people collectively to work together because they all kind of started, moving in different directions. They kind of some reconciled, some didn't reconcile. So that also is one of the factors where I think you'll see the takeoff being a little bit slower than has been anticipated.
Thank you, Mr. Tan. The next query again is directed to Mr. Rajgopal.
Yeah.
The query is, in light of the decision of SEBI to separate the role of the chairman with the managing director or the CEO of listed companies, what effect can such decision have on the enhancement of corporate governance culture in India, in especially in family-driven businesses in India?
Well, if you look at the UK, it's a fairly strong convention that the chairman and the CEO roles are separate and held by two different individuals. However, if you look at the US, the chairman and CEO are the same person in most companies. And when you consider that the majority of Fortune's most admired companies are based in the US, often with the same person as chairman and CEO, there is no split in the roles, including the likes of Apple and Amazon and so on. You'd think that there is also a merit to it because it has worked well for them. In India, the situation is somewhat different, which I think, again, if I refer back to what Mr. Tannen said, that even in the promoter companies, I think there's a growing expectation of the roles of the independent directors, the institutional shareholders in these companies. One would assume and hope that promoter chairman come CEOs are more cognizant of serving all stakeholders apart from their own set of representation. So it's a hard one to call. You can say simplistically, separating the roles would make sense, but you also have to see in the Indian context, a lot of companies have become successful that were founded and built by promoters and very closely managed by the promoters and their families, which have also worked well. To me, the more important issue is that where there is scope for corporate misdemeanors, there are effective mechanisms to have checks in place that prevent any sort of misuse of company funds, company priorities. And I think to some extent that is far more important than splitting the roles. But this is a personal view.
Thank you very much, Mr. Rajgopal. The next question again appears to be addressed to Mr. Tandon. This is your experience. How influential are institutional investors and other shareholder groups in monitoring and enforcing good corporate governance?
I think it's changing quite rapidly. And there's this whole belief that mutual funds and insurance companies don't vote. And I just want to put a statistic on the table, which is the fact that in my presentation, I said that institutional investors own roughly about 36% of the total equity across the broad market, which is if you look at the NSE 500. So if you look at this 35%, about 93% of this is voted on today. So if they're voting upon it, they're also having a conversation with management. They're also going and meeting them, talking to them about what is it that is a concern for them. So I think there is a growing engagement which is taking place between management teams and investors. And therefore, I expect institutional investors to have a far more powerful voice going ahead.
Thank you, Mr. Tandon. The next question appears to be directed to Mr. Rajgopal in the context of an independent director. What guidance would you provide to new independent directors while considering and approving any related party transactions with promoter group companies?
Well, when Diageo came into United Spirits as a controlling shareholder, now there was a history there of related party transactions with their wider group, which was the United Breweries Holding Company group, I think. And related party transactions used to run into several pages. And so what we did was, since we did not have the expertise to comb through these to determine its reasoning, we got one of the big four firms, not the auditors, but a different firm, to actually go through it and see whether they were commercially justifiable and certify the same to the board. So that was one form of assurance we got, where it was a complex area. But I think in most cases, the best way forward on these things is to spell out a policy which says what are the areas where related party transactions will be allowed and not allowed, where they're allowed, to spell out the parameters under which these related party transactions will be considered. Typically, the test being arm's length, the lack of other service or providers or suppliers, the prices being commercially benchmarked to the marketplace. Typically, you would also have a rule which says if a related party involves individuals that are linked to, let's say in one instance, like the promoters or their families, those are simply to be not allowed. It could be done with group companies, provided certain tests are followed, so on and so forth. And I think once that policy is spelled out, then it behoves the auditors to make sure those policies are followed and non-compliance is reported by exception. So that would be the other safeguard. Simply banning it when there are commercial advantages in having synergistic opportunities, I think that doesn't make sense.
If I may just come in on this, I agree with everything you've said. I'd actually add one one perspective, which is that it's good to have these predefined for a period of time. So it could be for 1 year, 3 years, 5 years, whatever it is. Maybe 3 years is the best. And therefore, if it's kind of coming up periodically to vote, it will also be good for investors, and it also ensures that the management and the board is sure in terms of if you envisage some benefits 3 years ago, are they still flowing as a consequence of this transaction or not? So, defining a tenure is always a good idea.
Thank you, Mr. Tandon. Thank you, Mr. Rajgopal. We have some time for a couple of more questions. I think this question appears to be directed to Mr. Daruwala. With many With many statutes imposing onerous responsibility on directors, we see increasing instances of competent individuals choosing not to take up directorships. Do you think any amendment in any law is required to attract competent people to directorships?
See, I think more than the amendment to the law, I think what we require is change in the mindset of the courts. Because what is happening is that there are a number of cases where the Supreme Court has said, the High Courts have said that, look, try to find out whether the person complained against was in charge of the management of the company, what was his role in the so-called offense. Now, despite that, it is very convenient for the complainant just to put all the directors in the complaint and make a bold statement saying that all of them were involved in the management of the company and all of them were involved in the offense. And what the court does, it says you go through the entire trial and then you prove that you were not involved. It should be the other way around. I think in the complaint itself, the court should insist that, please highlight in a specific manner what was the role of each of these people. And if it does not find any substance, it should dismiss it in the first instance. I think that gives a lot of confidence to the people who want to take up positions as independent directors. Making them to go through this entire pain of the court process, incurring time, expenditure, and money is not a good decision.
Thank you, sir. The next question is intended, I think, for Amit Jeevan. This is in the context of insolvency. What defenses can a director or officers take in the context of an insolvency or reorganization? Amit, you're on mute.
Yeah, okay. Can you hear me?
Yes.
Yeah. Okay. If I heard you correctly, I think the question was about defenses for directors. I think in respect of fraudulent trading, directors would need to show that they were not knowingly parties to the business affairs in a fraudulent manner. And as Mr. Darawala pointed out, in respect of claims of wrongful trading, the defense would be to show that the director did not know or ought to have not known that there was any prospect of avoiding the commencement of TRP process in respect of the company, and the director exercised due diligence in minimizing the potential loss to the creditors or the corporate debtor involved.
Thank you. One last question we can take up, and I think this will be directed to Krishna. Can an independent director render advisory or consultancy services through his firm to the company in which he's a director? Krishna, you're on mute. Okay, it appears that we have some audio issues. We'll just
now
take a one.
Yes, Srinivas, I can. I think it was.
Yeah,
so your question was relating to independent director rendering consultancy services. Yes, they can such kind of services, subject to that the transaction between the company and the organization where he's interested does not amount to 10% or more of the gross turnover where he's interested. Also, there should be appropriate disclosure made by the independent director to the board at the time of appointment as consultant, and the concerned independent director should abstain from voting on such agenda item. Additionally, these transactions should be ensured are at arm's length price, and competitive quotes should have been actually procured from other service providers.
Thank you. Thank you. We have already run out of our allotted time, and we still have over 200 questions that we have received. So we rest assured that we'll respond to these questions individually over the coming days. So with this, thank all the participants for taking out time on a Saturday evening to attend this webinar. We also extend a heartfelt gratitude to Mr. Rajgopal and Mr. Tandon for participating and sharing their views, as well as my colleagues, Mr. Darawala, Mr. Amit Jeevan Joshi, and Krishna Kishore. And insofar as our next webinars, we look forward to seeing you at our next webinar, which is scheduled on Monday, the June 29th from 4 p.m. onwards. The topic is SOPs, Employee Retention Tool during COVID, legal, FEMA, and corporate and tax issues. You can find the registration link as well as the schedule of upcoming webinars on our LinkedIn page. So thank you everyone for attending the webinar, and we hope to see you again soon at our next webinar. Thank you. Good evening and good night.
Thank
Thank you,
you.
everyone.
Thank you. Thank you, everyone.